The Federal Reserve is taking further steps in an effort to try and control skyrocketing inflation in the United States. More fiscal tightening in the pipeline, which can be seen in the minutes of the Fed's March meeting, which were released on Wednesday U.S. time. Yoo-jin with the details.
The U.S. Federal Reserve has hinted at taking a big step towards quantitative tightening, which refers to the central bank reducing its purchase of assets. Minutes from the Fed's March meeting released on Wednesday local time showed participants discussed reducing its balance sheet as well as raising the key interest rate. To start off, policymakers, quote, generally agreed on cutting bond holdings by a maximum $95 billion a month. This includes $60 billion in Treasuries and $35 billion in mortgage-backed securities, or MBS. At almost twice the peak rate of the Fed's last balance sheet trim from 2017 to 2019, which amounted to $50 billion, the caps could take effect as early as May and be phased in over 3 months or longer, depending on market conditions. The Fed's bond portfolio ballooned to $8.9 trillion after it purchased massive amounts of bonds and MBS to stave off economic shock triggered by the pandemic. Further interest rate hikes were also addressed during the meeting. According to the minutes, many participants deemed one or more increases of 50 basis points at future meetings as appropriate should inflation become more intense. This comes after the Fed raised its key interest rate to 0.25% in March, the first hike in more than 3 years. The minutes also explain that while the majority of Fed officials preferred a half percentage point hike in March, the decision was deterred due to uncertainties caused by Russia's invasion of Ukraine. The Fed's latest move comes in a bid to tame soaring inflation. The U.S. Consumer Price Index jumped 7.9% in February, a 40-year high. During the same period, the Personal Consumption Expenditures Price Index, the Fed's preferred measure of inflation, rose 6.4%, greatly exceeding the target range of 2%. The surge in energy and raw material prices, exacerbated by the war in Ukraine, is adding more concern. Yoo-jin, Arirang News.